Learning objective 2 is financial accounting and reporting. How do we look at these product and period costs? Product costs are those where there's a production cost item necessary to get it to be ready for sale. A period cost is everything else. An example of these would be items that you manufacture require raw materials, labor, and overhead. Those are product costs. Period costs are things that pass by quickly. Rent or travel or entertainment, those are examples of period costs. And they're just charged directly to the income statement without really becoming an inventory item. Let's look a little more deeply at the examples of product and period costs. First is product costs are the ones that flow through the balance sheet by way of assets into the income statement. They're related to production. Some examples are raw materials, supplies, depreciation on plant equipment, maintenance, utilities, etc. These are all items necessary for the manufacturing of the product. Some are direct like raw materials, some are less direct like the janitor that cleans the factory or an engineer that does the work on the production process. They're all necessary for production. So although they're not putting their hands on the product to make it, they are essential for the factory and its operation. So those are called indirect manufacturing costs. Then they're assigned to inventory. First stage is in the factory. So I like to think of inventory as having rooms. There's a room where there's supplies, there are raw materials. Then you have a room that is the factory where things are done. Then there's a room that is the warehouse where you store the items that you've completed and are ready for sale. And then finally we ship it out to a customer. As the inventory passes from room to room to room, it is accounted for that way. So we'll see categories of inventory later on, but this is just a preview of the types of accounts that will comprise the set of inventory accounts. And they're expensive, of course, when the customer buys your product. Once it leaves your hands and is now in the hands of the customer, your work is done. You get to record the revenue and you must record the associated cost for whatever you sold that customer. Period costs are items, as mentioned, that go flowing straight through to the income statement. Examples are depreciation on the showroom. Notice that depreciation on manufacturing equipment is charged to the product, but depreciation on a showroom or on a sales office or the headquarters are not relevant to the manufacturing of that particular product. These are examples of period costs. The flow of costs through the balance sheet. Let's go a little more deeply into the three items. We have direct labor, which are costs that are embedded into the product. They're steel or plastic, whatever you're manufacturing. And direct labor are the people that actually work on the product. Their hands are on the product that you're manufacturing. They're on the assembly line is one way to visualize it. And third are manufacturing overhead, and it's a whole bunch of things necessary, as we mentioned, to make the factory run properly and to affect the properly manufactured end product. These all flow into work in process, which again, think of it as a factory. Then they flow to finished goods, then cost of goods sold. As we incur costs, we increase the work in process. As we move from work in process to finished goods, we transfer it out by reducing the inventory balance in WIP and increasing the expense or the costs in the finished goods inventory. And then when we sell it, we decrease the finished goods and increase cost of goods sold. So you can think of it as a cascading effect as we move from level to level where the money goes. The product cost measurement also has some challenges. First, we don't really know the true cost until the end of the year, but we can't wait that long to make decisions. We need to make a series of estimations. Second is that we don't measure seasonality. There may be differences where it's not due to any mismanagement or over/under management. It's based solely on what happens in the flow of the business over the course of a typical year. And we might see that period to period, the cost will change because when you have high manufacturing output, that might give you opportunities to lower costs. If you have low manufacturing activities, likewise, it would flip the other way. It would lead to higher costs. Possibly the biggest challenge of all of this is looking at overhead. It's pretty clear what the raw materials are going into the product. It's also pretty clear what labor it takes to make the product. What is unclear is how do we allocate all this overhead, the factory rent, the factory insurance, the foreman's salary, the depreciation on all that equipment. All that has to be charged back into products. So if you had a year with a lot of production, the cost allocated for overhead might be small. If you have a relatively slow year, then allocating that same large dollar amount of costs will put a bigger burden on the fewer products that were manufactured. The allocation of overhead has 3 steps, and this is one method. This is the simplest method, and it's called the POHR, or using the predetermined overhead rate. First, we have to select a driver, and this is what drives the cost. What is it that is most associated with the incurring of manufacturing overhead in the product? Usually it's things like direct labor or machine hours. These are the most typical ways that we assign cost as far as overhead into products. Second is we can then compute the predetermined overhead rate by putting the total estimated cost for these items as the numerator, and the denominator put the estimated amounts for these cost drivers for the coming year. Notice that we're prospectively doing this. We're looking at this before the year begins. That's why we have the word predetermined. And the reason we're doing this is we can't wait for the whole year to pass to figure out our actual costs. We're going to do our best estimate, and as we go during the year, we'll be charging products for overhead and not waiting to the end of the year. So this is an important assumption that we will be doing when we put costs into our products. Third is then we apply the overhead. We have this predetermined number, POHR, think of it as done before the year begins, and then we have actual amounts of the driver used. So we can use the POHR times the amount of driver used, and that will allocate overhead. Let's start with an example showing how we implement the predetermined overhead rate. So here's an example. We have a company called Harmonic, and they predicted that their activity level will be 40,000 direct labor hours. So that's the total they think for the next year of the primary driver of their costs. Second, their overhead is estimated to be $128,000 for the coming year. In January, they had actual direct labor hours totaling 2,200 hours. So how much overhead will be charged to the company? We'll hop into Excel and bring this information. What is the cost driver? We determined that it's going to be direct labor hours. And the total estimated for next year equals, and we'll put it here, that 40,000 hours. Next is we could determine the predetermined overhead rate by saying what's our total estimated overhead. And that number is $128,000. We can determine the POHR is simply the estimated dollars, 128, divided by the total estimated driver. So let me just clean this up. So this would equal plus 128 divided by 40. POHR in this case is 3. I'll fix the formatting again. Is $3.20 per direct labor hour. All right, so now we can apply it. So in January, we had actual drivers equal to the direct labor hours equals, and the number of hours used is 2200. Now we could say the application, apply the POHR, and that is a rate that we saw previously, 320. The dollars charged for overhead will equal the direct labor hours times the rate. So we will charge $7,040 in January for overhead. So that's the operation of the predetermined overhead rate. It's pretty simple, right? But notice that everything here is based on before the year begins. And that this is also a rate, which is an assumption before the year begins. This then occurs after the year is underway, so that they happen in different time frames. That's often a confusion here. What is the impact of technology? As you might imagine, direct labor could be very expensive, and there is a temptation to move toward more and more automation. What this does is reduces the direct labor hours. However, it increases the amount of overhead due to machinery and other investments necessary to replace labor. We're seeing that over time, we're moving further and further away from labor and more toward overhead. This is an important consideration for what we're going to see in the next chapter related to ABC. But we thought I'd point it out since we're in the neighborhood.